A major inheritance tax change is coming that will reshape the future of UK family farms. The government claimed only 27% of farms would be affected. The reality? Closer to 75%. This isn't about large estates. It targets a core vulnerability, being land-heavy but cash-light. This means new tax bills could force the sale of land that's been in your family for generations. In this video, we'll break down the new rules, reveal the hidden tax traps, and outline the strategies you need to protect your farm's future. First, the headline number. From April 2026, 100% agricultural and business property relief will be capped. What happens to value above that $2.5 million? Relief drops to 50%, creating an effective 20% inheritance tax on the excess. There is a significant improvement from the initial proposal. The allowance is now transferable between spouses. A couple can protect up to £5 million. This is a massive change from the original use it or lose it plan, which would have wasted the allowance on the first death, creating a huge tax cliff edge. So we have the new numbers, a £2.5 million cap, 50% relief above, and spousal transfer. But why is this still a major threat to so many farms? The reason is profitability. The agricultural sector operates on very tight margins. Even with a 10-year payment window, the tax bill could wipe out a decade of profit. The first major complication is that the $2.5 million cap is not just for your farm assets. It's a combined cap for assets qualifying for both APR and BPR. Because of this combined cap, how you structure your business is more important than ever. These decisions now have multi-million-pound tax implications. So what does this mean for a farm with holiday lets or a farm shop? Does it all get lumped together? You'll see the exact calculation very soon. Why did the cap increase from 1 million to 2.5 million? It was the direct result of intense lobbying and anger from farming communities who saw the existential threat. We've seen the rules and the complications. Now let's put some numbers on it. How does this actually play out for a family farm? Let's take a single individual owning a farm estate valued at $6 million. Previously, with 100% APR, the inheritance tax bill would be zero. Under the new rules, the first $2.5 million is covered, but the remaining $3.5 million is only 50% covered, leaving $1.75 million exposed to IHT at 40%. The result? A sudden inheritance tax bill of £7,000, a bill that simply did not exist before this change. Remember the land-heavy, cash-light problem we mentioned? Where does a farm find $700,000 in cash without selling assets? For most, it's impossible. That was a straightforward example. But real farm businesses are rarely that simple. Let's look at the nuances that can trip you up. Thinking of gifting assets to get ahead of the 2026 deadline? Be careful. Gifts after October 2024 could still fall under the new cap if you die within 7 years. One existing principle remains, the Balfour Principle. This allows a business that is mainly trading to qualify for BPR, even with some investment activities. Back to our question. A farm with holiday lets. Thanks to Balfour, the whole business might qualify. But the value of all those assets counts towards your single $2.5 million cap. A further complication is appearing. The government is already looking at rules to stop farmers from fragmenting assets across trusts to claim multiple allowances. These details show this is a minefield. So what is the cumulative effect of all these changes on the industry and the economy? Let's connect the dots. We started with the government underestimating the impact. Combine that with the land-heavy, cash-light reality, and forced sales become a systemic risk. This isn't just a tax issue, it's an economic one. Farming businesses are forecasting reduced investment and job losses as they hold cash for potential tax bills. Historically, APR attracted outside investment into farmland. By limiting this relief, the changes may reduce the attractiveness of farmland, potentially causing values to fall. The picture is clear. The financial stability of family farms is under pressure like never before. So, what is the single most important action you can take right now? The answer is proactive and urgent estate planning. Every aspect of your succession plan, will, and business structure must be reviewed in light of these new rules. One new planning tool is the inclusion of environmental land in APR from April 2025. This offers a potential financial advantage and should be part of your review. This new APR threshold isn't just an adjustment. It is a fundamental shift. It changes the math of passing a farm to the next generation. The time to act is now. Consult with your tax advisor, your solicitor, and your family. Don't let a preventable tax bill be the reason your family's legacy ends with you. Subscribe for more updates on agricultural finance and tax law.